In today's video, we will go through why the dollar-yen currency pair is so volatile. The 5 key topics that we will cover are interest rate differentials, economic data releases, geopolitical events, market sentiment, and monetary policy. Firstly, interest rate differentials. Interest rate differentials refer to the difference in interest rates set by the central banks of two countries, in this case the US Federal Reserve and the Bank of Japan. When the Federal Reserve raises interest rates, it makes the US dollar more attractive to investors because they can earn higher returns on investments denominated in dollars. Conversely, if the Bank of Japan keeps its interest rates low, the Japanese yen becomes less attractive. This difference in interest rates can cause significant fluctuations in the dollar-yen exchange rate as investors move their money to take advantage of higher returns in the US. This movement of capital can lead to increased demand for the dollar and decreased demand for the yen, causing the exchange rate to become more volatile. Essentially, when investors move their money to take advantage of higher returns in the US, they sell yen to buy dollars. This increased demand for the dollar and decreased demand for the yen can cause sharp fluctuations in the exchange rate, making it more volatile. Secondly, economic data releases. Economic data releases are scheduled announcements that provide insights into a country's economic performance. These include indicators like GDP growth, employment figures, and inflation rates. For example, if the US releases strong employment data, it suggests a robust economy, which can lead to a stronger dollar. Traders and investors react quickly to such data, buying or selling currencies based on their expectations of future economic performance. This rapid reaction can cause sharp movements in the dollar-yen exchange rate. Similarly, if Japan releases weak economic data, it can lead to a weaker yen, further contributing to volatility. The most recent economic data for Japan shows that the annual inflation rate was at 2.8% in July 2024. This rate has remained steady for 3 consecutive months, marking the highest level since February. Key contributors to this inflation include a significant rise in electricity prices, a 22.3% increase, and gas prices, a 7.4% increase, following the end of energy subsidies. Additionally, prices for food, housing, and healthcare have also seen increases. This steady inflation rate suggests that the Japanese economy is experiencing moderate price increases, which can influence the yen's value as investors react to these economic conditions. Thirdly, geopolitical events. Geopolitical events encompass a wide range of occurrences, including trade tensions, political instability, and natural disasters. These events can significantly impact investor sentiment and cause sudden changes in the dollar-yen exchange rate. For instance, if there is political instability in Japan, investors might lose confidence in the yen and move their investments to the dollar, which is considered a safer option. Similarly, trade tensions between the US and other countries can affect the dollar-yen pair as investors react to the potential economic impacts of such tensions. What are the current trade tensions? Well, in the US and Japan have been working to resolve trade disputes, particularly in areas like automotive and semiconductor products. Recently, there have been discussions about the acquisition of US steel by a Japanese company, which has faced opposition from the US government. These trade tensions can lead to uncertainty in the market, affecting the dollar-yen exchange rate as investors react to potential economic impacts. Additionally, the recent election in Japan, which saw Prime Minister Fumio Kishida re-elected, is likely to influence trade tensions between the US and Japan. Kishida's administration has been focusing on strengthening security ties with the US to counter China's influence. This alignment on security matters may help ease some trade tensions, as both countries work towards common goals. However, ongoing negotiations and policy decisions will continue to play a crucial role in shaping the trade relationship. Fourthly, market sentiment. Market sentiment refers to the overall attitude of investors towards a particular market or asset. Both the dollar and yen are considered safe haven currencies, meaning they are seen as stable and reliable during times of global uncertainty. When there is a crisis or significant uncertainty in the global markets, investors tend to flock to these safe haven currencies, This can cause rapid shifts in their value as demand for the dollar and yen increases. A safe haven currency is one that investors consider stable and reliable during times of economic or geopolitical uncertainty. The USD and JPY are both seen as safe haven currencies because they tend to retain their value or even appreciate when global markets are volatile. Investors flock to these currencies to protect their capital from potential losses in riskier assets. The dollar-yen pair can experience heightened volatility as investors quickly move their funds between these two currencies based on their perceptions of global risk. Volatility is affected by the rapid movement of funds based on investors' perceptions of global risk. When there is a crisis or significant uncertainty, investors quickly move their money into safe haven currencies like the dollar and yen. This sudden shift in demand can cause large swings in the exchange rate, leading to increased volatility. For example, during a geopolitical crisis, the demand for safe haven currencies spikes, causing their value to fluctuate more dramatically. Fifthly, monetary policy. Monetary policy involves the actions and statements made by central banks, such as the Federal Reserve and the Bank of Japan, regarding the management of interest rates and the money supply. Unexpected changes in monetary policy or forward guidance can lead to significant volatility in the dollar-yen exchange rate. For example, if the Federal Reserve unexpectedly announces a rate hike, it can lead to a sudden strengthening of the dollar as investors anticipate higher returns. Conversely, if the Bank of Japan announces measures to stimulate the economy, it can lead to a weakening of the yen. These policy decisions and announcements can cause large swings in the exchange rate as traders and investors adjust their positions. The Bank of Japan is currently maintaining a very accommodative monetary policy. As of the latest updates, the Bank of Japan has kept its interest rates extremely low and continues to implement measures like yield curve control to stimulate the economy. The Bank of Japan has also been involved in quantitative easing, purchasing government bonds to inject liquidity into the financial system. These actions are aimed at combating deflation and supporting economic growth, but they also contribute to the volatility of the yen as investors react to these policy measures. I hope this detailed explanation helps you understand the factors contributing to the volatility of the dollar-yen currency pair. Thanks for watching.